Hot on the heels of a week that saw US CPI and PPI moving towards the upside. We've seen a similar kind of thing in terms of expectations for the UK. Both headline and core inflation expected to increase. It's an interesting one because we're expecting to see negative month-on-month movements in terms of UK inflation. So plenty to pick through, but significant implications in terms of market expectations around the Bank of England and, of course, knock-on impacts for the likes of the pound and the FTSE 100. So let's get into it. So, like I said, there is an expectation that we see higher inflation on both headline and core. So 2.7 from 2.5 on headline, 3.5 from 3.2 in terms of core. And then you look at the month on month. So minus 0.3 expected for headline, minus 0.7 expected for core CPI. And that really points towards base effects coming into play. That's why we always look at these month on month metrics to try and gauge exactly what the direction of travel is over the nearer term and the recent trajectory rather than simply looking at year on year numbers. And certainly, this is going to be a particularly interesting occasion for that reason. Part of it comes down to seasonality. Now, this is headline is the top section, core is the bottom section. What we can see here is that once a year for January, you'll see a negative reading. You can see it 2022, 2023, and 2024 with those negative metrics. Notably, that 2024 figure was particularly strong towards the downside. And so we've got a pretty significant bar to try and reach to stop inflation moving towards the upside. And that's why markets are expecting to see both headline and core year-on-year inflation moving higher. Now, you might wonder why January sees negative inflation, but bear in mind, a lot of the time we will see significant sales during December for the Christmas period. And then retailers will often have to drop their price to try and either compete within January or get people to spend more because they probably spent quite a lot of money already in the December period for Christmas. Now, here's the breakdown in terms of both headline and core CPI. So headline is blue, core is orange. And what can we see here? So first and foremost, headline inflation's been rising and then flatlining. Core inflation's just been struggling to really get below that 3% mark, really. So it's been sort of sideways for much of the past near enough sort of 6 to 8 months. And then we look at the sort of monthly metrics. So it's sort of hot and cold, really. You can see here that dotted line in the middle section here. The dotted line highlights where we need to be, there or below, to get back to target. And you can see the December numbers came in hot. The November came in cooler. The October came in very hot. September came in cooler. August hot. July cooler. So it's on off, on off. But on average, that sort of works out, because if you look at the 7-month annualized, which essentially is my way of saying once the next sort of 5 months are out the way, where are we going to be? That's because if you look at the month-on-month metrics, you've got January, which of course are negative. Then you've got February, March, April, May. All of those are pretty hefty numbers. So I'm looking beyond that and thinking, what's our trajectory since then? And where are we likely to be by the end of H1? And you can see here, headline inflation on a 7-month annualized basis, 2.1%, core down to 2.58, so 2.6 essentially. So that means that by the midway point of this year, there is a strong expectation on the current trajectory that we will see inflation by and large back at target. Headline at 2.1, core at 2.6. That's the kind of area where you think that the Bank of England is going to feel quite confident about easing further. And certainly, the UK is not in the same position as the US in terms of overheating or in terms of the economy being too strong. Certainly that isn't the case. We did manage to post a lovely 0.1% GDP number recently, though. So very impressive stuff. So this is one thing that I've been looking at, and this is wages. So you can see here total wages in the sort of orangey yellow. It's rebounded, but it's been on a downward trajectory. Excluding bonuses, we've also seen rebound recently. So there has been a sort of recovery or rebound in terms of those wage figures. CPI, in terms of the headline number, you can see that it has also similarly popped a little bit, but the question mark here is whether we're bottoming out, whether this is the beginning of a resurgence or not. And then services inflation, that's really important. Much of that downside has been driven by services inflation. And while it remains elevated above that 4% mark, it does continue to move in that downward trajectory, which points towards things like, say, food prices and energy prices as being key within the recovery that we have been seeing of late, not necessarily the underlying services inflation numbers. So if we're looking in terms of the real wages, and that's essentially wage growth when factoring in the rate of inflation, we're now in positive territory, which is a positive thing. Of course, throughout that sort of 2022 period in particular, we saw a collapse in real earnings, which is detrimental to the UK economy. That being said, if you have real earnings that are too strong, then that can cause another surge in terms of inflation. If people suddenly feel flush with cash and they're earning more than the prices are going up, by a significant degree, then you're likely to see higher demand and the possibility of people pricing accordingly. So some question marks about whether we're going to see a reflation move in the UK around strong real earnings, a rebound in terms of both total and excluding bonus wage figures. And so that, the fact that this time around it looks like, or certainly markets are expecting to see, inflation on both headline and core move towards the upside in the year-on-year figures, that could cause some concerns. Now, like I've said, ultimately we can look beyond that because we know that, okay, we've got some difficult comparatives for the January numbers, because if you look at that core figure from last year, it's minus 0.9, headline minus 6, whereas markets are expecting to see minus 0.3 and minus 0.7. That's why we're expecting to see both move towards the upside. But beyond that, you can see there's an expectation that we will see significant disinflation over the coming months in February, March, April, May, and then by the midway point of the year, essentially inflation should be curbed. That's the current trajectory we're on. If we do see a big resurgence in terms of wages, then that could be troublesome. That could be something that causes concern for markets. And part of that feeds into yields. So the trajectory of yields, 10-year yields, 2-year yields, 5-year yields, 1-year yields, they have different spectrums and they sort of provide a different outlook for different periods of time. But ultimately, what we have been seeing recently is this sort of downward trajectory in terms of yields. And that's exactly what the Bank of England will want. That's exactly what the government will want. It brings down borrowing costs. And in a way, it reflects the expectation of lower inflation in the UK. I've inverted the FTSE 100. And this essentially highlights the fact that if we see lower yields, we're likely to see the FTSE 100 rise. If we see a pop in terms of UK yields, and we have started to see them move a little bit higher over recent weeks, then that points towards a possibility of underperformance for the FTSE 100. And conversely, if you're looking at, say, high inflation, that would likely mean higher yields, and that would likely mean a stronger pound. So if we see high inflation numbers, if markets react to the rise in terms of headline and core inflation, if that's how it comes to pass, then we're looking at the possibility of a stronger pound. We're looking at the possibility of a weaker FTSE 100. This is comparing the, not US. So the UK versus the Canadian 10-year yield overlaid with the pound against the Canadian dollar. And this is what we wanted to look into in terms of the FX space. So this is also highlighting the fact that the comparative yields will impact the price of a currency. If we see high inflation, then we're likely to see higher yields in the UK, then we're likely to see a stronger pound. And the Canadian dollar is an interesting one at the moment because they continue to cut interest rates and they're in a position where they could get hit by tariffs from the US. And so whilst we saw that 1 month delay on the sort of fentanyl thing, that doesn't necessarily mean that they're out of the woods. And if we see that come back into play, there's a possibility of further weakness in terms of the Canadian dollar. Another way of looking at it here is what feeds into these yields. Well, part of it is also the strength of the economy. So if we have a strong economy, and then we're likely to see a more cautious approach from the Bank of England. If we see a weaker economy, we're likely to see a more dovish approach from the Bank of England and therefore lower treasury yields. So the flash services PMI, remember the UK heavily reliant on the services sector. As you can see here, weakness in terms of the UK economy, the proxy here is services PMI, provides a weaker pound against the US dollar. And essentially, this is an interesting one because, the pound against the US dollar is not only the pound representing the economy, but also the US dollar, where if you see a sell-off around UK economic weakness, you're seeing the possibility of haven demand from the US dollar because people are fearful that this is indicative of something that's going to be happening around the world. So let's round up this section and we'll get into the chart. So this is the outlook for the Bank of England for essentially this year. And you can see, by and large, markets are expecting the first move to come in May, or the first next move to come in May, 68% chance of that, not expecting a cut in March. And that stands to pass, especially if we see a higher number in terms of inflation this time around. I don't think you're going to see people necessarily emboldened for this rate cut in March. So rate cut in May, 25 basis points. Then the next one is August, and we're expecting another 25 basis points. And then that's pretty much it for the year, right? So you might see one at the back end of the year, but there's a good chance we just see 50 basis points worth of cuts. Now, this time around, what are we expecting? So even if we see better than expected inflation numbers, then we might see headline and core CPI stay flat, right, in terms of year on year. So that's not necessarily super encouraging. Like I said, the big disinflation kicks in next month. And so there's a possibility of it coming in weaker than expected, but I don't expect to see pound weakness per se off the back of that. But if it came in hotter than expected, then I think you'd see a disproportionately bigger move compared to if it came in the opposite direction, and the potential for pound strength off the back of that. So let's jump into the chart. This is the chart for the FTSE 100 at the moment. So that's the gold chart. So this is the chart for the FTSE. At the moment, things are looking very strong. We have this consolidation phase, and we've been breaking out from that sort of rally, consolidation, rally, pullback, rally. We've pulled back into the 38.2 Fibonacci level, now finding some support once again here for the FTSE. Here's the 4-hour chart. In actual fact, the hourly will probably give us a bit better. So you can see here that the intraday pattern of lower highs gets broken if we break the 87.70. If we come out with hot inflation data, it could put a bit of a dampener on this. Now, bear in mind that we do, of course, have talks about a possible ceasefire between Ukraine and Russia. And if that comes to pass, that does provide the basis for possibly outperformance in European equities. I would say probably more so geared towards heavy manufacturing nations like the German. So the DAX would certainly come into the spotlight. But nonetheless, you're looking at a rebound here set within a very strong trend that we have been seeing of late. But I would say come into this release with a bit of caution in my mind. I think there's a good chance that if we do see it coming in hotter than expected, we could see some downside coming into play for the FTSE 100. Of course, if it comes in weak, we could see that sort of lift the FTSE, and I think the underlying trend is bullish. So even if we saw a pullback in terms of these numbers, or based around these numbers, then I don't necessarily think that forms the basis of a top for this market. For example, it would just likely come into a deeper retracement phase. But certainly that's one worth watching. Another one to be watching out for here is the pound against the Canadian dollar, for reasons I previously explained. Now, firstly, we've got a very nice trend in play here. So we're playing within the trend. Secondly, you can see that we've got this sort of consolidation range-bound market that's been holding for pretty much since sort of July 2024, really, that these lows around sort of 175 kind of areas. And then the highs are roughly around here. So 1815, we've hit 1, 2, 3, 4, 5 times. And so we're turning higher at the moment. Do we have further downside to come into play? Let's just see whether this tallies up in particular with 61.8. No, so it's sort of in the middle of the deep fib zones, but it has come into a deep fib retracement. You can see on the hourly time frame, there we go, that we're sort of at this key resistance level. So this pattern of lower highs, lower lows sort of breaking at the moment. So there is a good chance that we have bottomed out here. Certainly if we see a pullback, bearing in mind we are seeing this sort of rising wedge formation at the moment. So if we look at this at the moment, we have got that sort of wedge pattern, which does signal the possibility of a pullback coming into play. But if we do see that pullback, there's a possibility of coming in here and then maybe regaining ground. So that is possible, or we can break up through trendline resistance here. But I do think now that we've broken through this 1.787 swing high, then it looks in place to potentially recover back up towards the top end of this range once again. And like I said, the key thing here is markets are expecting inflation to move higher. If we see it coming higher than that, higher than expectations, I think that forms the basis of strength for the pound, and in particular against the Canadian dollar, given the fact that markets are expecting rate cuts and the possible breakdown in relations with their number one trading partner just over the border with the US. And so that's a key one. Now, what I want to stress at the end of this, of course, is the fact that, yes, we're talking about the possibility of a stronger pound and stronger inflation and growing fears around the possibility of less rate cuts this year. But bear in mind that I've already shown you a pathway for us to get back down towards relative normality when it comes to inflation by halfway through this year. So even if we do see, inflation rise this time around, it doesn't necessarily mean that the Bank of England is not going to cut this year, or we're going to see a rapid deterioration in terms of those expectations. Because in the coming months, I do expect to see UK inflation falling in a meaningful way. And part of that is also managing to keep down energy prices. So hopefully Donald Trump can do exactly that. And I think a deal with Ukraine and Russia, if that comes to pass, does provide the basis for disinflation with lower gas prices, lower oil prices, and lower food prices coming in the region of Europe in particular. And that could provide a boost ultimately to those hoping for rate cuts from the Bank of England. I hope that's been useful. Make sure to like, subscribe, and follow for more content like this. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day.